Okay. Good day, audience. I hope you all are fine. Okay. So, kindly tell me everything is perfect. The voice and the picture and the screen sharing, everything is perfect. Please write in the chat box. Everything is perfect. Okay. Now, yesterday we did question number 2 of December 2021 attempt, and then we discussed some issues which may come in current issue section as well. Okay, technical aspects. Now, before moving on to question number 3 of December 2021 latest question, first of all, want to touch this topic, and this is also a little technical topic, and it may come now. Different treatment in individual and consolidated books means same transaction, but different treatment in individual books and different treatment in consolidated books, right? Okay, so these are some examples. These are some examples related to that. The first one is related to IAS 40. The first one is related to IAS 40. Look at this circle. Let us say parent company has given a building to S company on rent. Parent company has given a building to S company on rent. Okay, now if you see parent company individually, that means parent company is earning rental income from that building. If you see parent company individually, that means parent company is earning rental income from that building. So in the individual books of parent company will apply IS 40 because parent company is earning rental income, right? Okay, but for the purpose of group, hope you remember the whole group is a single thing. Whole, for the purpose of consolidation, whole group is a single unit. For the purpose of consolidation, this building is being used within the group. That's why IS 16 will be applied in the group accounts. IAS 16 will be applied in the group accounts. Okay, so this was the first example. Separate treatment in individual books, same transaction, but separate IS in the consolidated books. Okay, now the second example. I saw this example in a past paper of old SBR. The old SBR paper was P2 paper, and I saw a 2005 paper. The name of the question was J. Now it's not available, but I saw this question. What is this? P company planned to sell non-current asset to S company before year end. Now wait, I'm sure you all are aware of IFRS 5 non-current assets held for sale. IFRS 5 non-current assets held for sale and discontinued operation. You know, whenever you classify any non-current asset as held for sale, you must meet a certain criteria. And the biggest thing in that criteria, you have to sell it to somebody else. You don't need to sell it yourself. Definitely you are selling to some external party, not yourself. Okay, this is a very important point. Now in that question J, it was given, look at me and listen very carefully. It was given that P company has signed an agreement with S company that after 5 days or 10 days of the year end, parent company will transfer his non-current asset to S company. That means the deal was confirmed. That means it is for sure confirmed thing that parent company will transfer his non-current asset to S company. So when this is a confirmed thing, so in the individual books, of parent company, we should apply IFRS 5 non-current asset held for sale, and we should treat this asset as a current asset. Okay, right? And one more thing, from the day we classified this asset as held for sale, from that date onwards we won't be booking any depreciation. From that day onwards we won't be booking any depreciation because we don't depreciate current assets. Okay, so now in the individual books IFRS 5 is perfect. In the individual books of parent company IFRS 5 is perfect, right? But now come to the consolidated books, single unit, the consolidated books. Just think, parent company selling to S company, parent company selling to S company, that means within the group. So within the group it's not a sale. That means this asset will be used, this asset will be used within the group, this asset will be used within the group continuously. So with for the group accounting purpose still IAS 16 will be applied. For the group accounting purpose still IAS 16 will be applied. Now just for your easiness, I'm telling you something extra. Please open your ears. Now in the individual books you have classified as held for sale, but in the group accounts you have to record it as a non-current asset, IAS 16. So in that case now you normally individual books are given in the question in a practical paper, in complete practical paper individual books are given and you have to make consolidated books. So now you need to do certain things. First of all, you need to shift that asset from current asset to non-current asset. Number two, you have to book certain depreciation as well, because in the individual books the day you classified this asset as held for sale, you stop booking depreciation. Okay, but for the consolidation purpose this is a normal non-current asset. For the consolidation purpose this is a normal non-current asset. So in that case you have to book some extra depreciation as well. Okay, okay. Now the third example, one guy's also fair value adjustment. No, one thing I can say, at the time of held for sale sometime we book impairment. At the time of held for sale sometime we book impairment. So if parent company has booked any impairment, this impairment needs to be reversed in the consolidated books. This impairment needs to be reversed in the consolidated books. Okay, so these were the two examples. Now moving on for third example, this is related to hedge accounting. My dear students, I'm sure by now you all know the conditions for hedge accounting. If you want to apply hedge accounting in your books, you have to take permission from auditor and you have to fulfill certain conditions. You have to fulfill certain condition, and one of the biggest condition is you have to prove your risk. What is your risk? If there is a risk in your book, then you can hedge it, because through hedge accounting you reduce your risk. Through hedging you control your risk. So first of all you need to prove whether there is a risk in your books or not. Okay, right? Now, and without risk you cannot do hedge accounting. If you don't have any risk, if you don't have any exposure, you cannot book hedge accounting. Right? Now listen this example. uh Before this point number 3, I give you a layman example so that you can understand point number 3 easily. Listen, let us say today I was me and my brother watching a match between Pakistan and India, or Pakistan and England, any cricket match. Okay, so we entered in a bet. Okay, let us say gamble. I said if Pakistan wins, I'll pay you 10,000. I say this to my brother, if Pakistan wins, I'll pay you 10,000. And my brother said, if England wins, I'll pay you 10,000. Okay. So that means if Pakistan wins, that means I have to pay. That means I'll lose the bet. And if England wins, my brother will lose and I will win. Okay. So in the individual books of me and my brother, there is a risk. In the individual books of me and my brothers separate books, there is a risk. Yes, one of us will win and one of us will lose. Yes, there is a risk. But if you consider it as a family, if you see both of us as a family, then there is no risk. There is no risk. Why? One brother will win and another brother will lose, so net effect will be zero. So same is the case here. Same is the case here. See, family books means consolidated books. Family books means consolidated books. Family books means consolidated books. Listen, P company buying goods from S company in future for fixed price. P company buying goods from S company in future for fixed price. Now they have risk in their individual books but not in the consolidated books. Yes, yes, easy, easy. Just use your brain. Be relaxed. Today, parent company promise to S company that yes, I'll buy I'll buy inventory at the rate of rupees 100 per dollar. After 1 month, I'll buy a certain inventory, let us say steel. I'll buy steel from you at 100 per dollar, 100 per dollar rate. After 1 month, the rate is fixed. Okay, now let us say after 1 month the real rate goes to 110. The real rate goes to 110. So that means parent company will win, because now parent company will buy for just $100. So parent, in this case parent company will win and subsidiary company will lose. But on the other hand, if the prices goes down, parent company will lose and subsidiary company will win. So now yes, there is a risk in the individual books of parent and subsidiary. There is a risk in the individual books of parent and subsidiary. There is a risk in the individual books of parent and subsidiary. There is a risk of in the individual books of parent and subsidiary. But in the consolidated books, family books, there is no risk, because consolidation is like family, group is like family. In the group books there is no risk. So in the individual books, yes, hedge accounting is allowed, but in the consolidated books hedge accounting is not allowed at all. Did you understand? Please tell me. All of you please, all of you please comment. Did you understand these 3 points? Okay, now next, at the rate, this is very routine. The fourth point is related to the fourth point we teach in F7 FR level. Listen, you all know when parent company acquires S company, when parent company acquires S company, so parent company brings everything of S company to fair value. Parent company brings everything of S company to fair value, remember, right? Now the question arises, sometime what happens when parent company acquires S company has got a contingent liability disclosure. S company has got a contingent liability disclosure, a contingent liability disclosure. S company has got a contingent liability disclosure in his individual books. Okay, so individual books according to IS 37, it's okay, because the outflow probability is only 30% or 40%, that means less than 50%. So in the individual books the disclosure accounting is perfect. But you know, for the purpose of consolidation, whenever parent company acquires any company, whenever parent company acquires any company with contingent liability in his books, then according to IFRS 3, you need to, there is a requirement, you need to capitalize, you need to record this liability if fair value of that liability is possible. If fair value of that liability is given, then you need to record that liability as a fair value adjustment at acquisition date, remember, right? So again, there is a difference of treatment in the individual books of S company. In the individual books of S company, it's a disclosure, but for the group accounting purpose, you need to recognize certain contingent liabilities. Yes, if the fair value of that liability is available, if the fair value of that liability is available, if the fair value of that liability is available, if the fair value of that liability is available, right? Now the next thing, this is something non-routine thing for some students, but still you must know. You know, just think when parent company, open your eyes, when parent company acquires S company, when parent company acquires S company, normally this acquisition is done through shares. When parent company acquires S company, normally this acquisition is done through shares, okay? Like parent company has bought 80%, 90% or 100% shares, okay? So in the individual books, hope you remember, in the individual books, what we do, in the individual books, what we do, we write investment, we simply write investment on the asset side. In the individual books of parent company, we simply write investment on the asset side, okay? And in the individual books, we have certain options available. See the red, see this. In individual books, it may be recorded at cost. Yes, you can record it at original cost. You can record that investment at original cost. You can record that investment at fair value, or you can apply equity accounting as well. So in the individual books of parent company, the shares of subsidiary company are recorded according to one of these three treatment, according to one of these three treatments, okay? But in the consolidated books, it will be, it will be eliminated and proper consolidation is done, yes. But when you make consolidated accounts, you cancel out investment, and what you do, you do complete adding together, right? You remember? So for consolidated books, we need to bring investment in subsidiaries at its fair value at acquisition date. This is a technical thing, I'll repeat it. First relax, first read it. I repeat, in the individual books of parent company, you can record investment in subsidiary. You can record investment in subsidiary at cost. Yes, it is allowed, or at fair value. This is also allowed, or you can do equity accounting. These three, you can opt one of the policy, right? But in the consolidated books, you simply know, we cancel out this investment, and we do complete adding together, we do complete consolidation accounting adding together, okay? Now these lines are very important, these are the real lines. See, for consolidated books, we need to bring investment in subsidiary at its fair value at acquisition date, at its fair value at acquisition date. Because why, listen, because acquisition date fair value is used in the computation of goodwill. Acquisition date fair value of consideration, fair value of shares, is used in the calculation of goodwill, and that is to be cancelled out. So what if sometime it happens, and in the previous papers of old SBR means P2 papers, I have seen these questions, and definitely you guys also, you must know about it, that for example, listen, this is 1st January 21, and today I acquired parent company. I am parent company, and today I acquired subsidiary company shares for 150. Today I acquired subsidiary company shares for 150, and in the individual books, of parent company, I picked the fair value accounting. And I recorded the investment of subsidiary company as fair value through PNL. I recorded the investment of subsidiary company as fair value through PNL. Okay, so when in the individual books you are doing accounting of fair value through PNL, so definitely you need to bring it to fair value at each reporting date. So let us say after takeover. See, this is the area of after takeover. See, after takeover, in 1 year, the fair value increased from 150 to 200. The fair value increased from 150 to 200. So definitely in the individual books of P company, the accountant made this entry, investment debit PNL credit. Accountant made this entry, investment debit PNL credit. But now when you start consolidation accounting, you, the first thing you should do is to bring investment at this value. See, This is acquisition date. This date it is acquisition date. This date is acquisition date. So you must bring the investment of subsidiary to fair value at acquisition date. And how you will bring this to fair value at acquisition date? By reversing. See, you need to reverse this entry. You need to reverse this entry. Then only you can do consolidation. Okay, so this is the requirement. This is the requirement of IFRS 3, that if in the individual books you are doing fair value accounting, if in the individual books of parent company you are doing fair value accounting, so whatever fair value differences you have booked after takeover, whatever fair value changes you have booked after acquisition, you need to reverse it for the purpose of consolidated books, for the purpose of just consolidated books. Otherwise, you know what will happen? Two parallel accounting will work. Two parallel accounting will work in consolidated books. In consolidated books, you will be booking gain as well of shares, as well as you are also recording the profits and complete subsidiary as well. So this will be double accounting. So first you need to reverse the fair value gains or losses. If you have recorded after the acquisition date, you need to reverse it. Okay, have you done it? Got it? So these few things you must know. These are the differences between individual books and consolidated books. Individual books and consolidated books. And you know, sometimes examiner test this knowledge of individual interaction between individual books and consolidated books. Individual books and consolidated books. Individual and consolidated books. Okay. Point four is about F7. Point four is F7. Listen, point four is what? Very simple. Listen, when parent company acquires subsidiary company, when parent company, listen, when parent company acquires subsidiary company, and if there is a case on subsidiary company, for example, there is a case on subsidiary company, but the chances of outflow is only 30%. The chances of outflow in that case is only 30%. So in the individual books, we will apply IS 37, and IS 37 says whenever the chances of outflow is less than 50%, you just need to make disclosure. So in the individual books, you will be making only disclosure, right, of subsidiary, and this will be given to you ready made. But for the purpose of consolidation, IFRS 3 says that if there is any contingent liability in the books of S company at the date of takeover, you need to recognize it. You need to recognize it in the consolidated books, and this transaction will be treated as a fair value adjustment liability. This transaction will be treated as a fair value adjustment liability. Fair value adjustment liability. Okay. Now let's move towards the question number 3. Let's move towards question number 3 now. First of all, I have a request. This is a practical question. The 50% question of this part is somehow practical. So I would request you to keep a pen and paper with you if you want to understand each and everything. Okay, pen and paper with you, pen and paper with you. Okay, so you can make the double entries yourself, and you can involve in the question. You can involve in the question. You can involve yourself in the question. Okay. Now, name of the question is STEM company. Name of the question is STEM company. Now, I would say that majority of things related to this question is basics, like FR level, F7 level. Majority of IFRS 16 part of this question is like FR level, to be very honest. Just keep a paper and pen with you, and make easy entries, easy, and you will understand. Okay, I will keep repeating things as well. And one more thing, the first requirement which we will be doing, is 13 marks, is basically 13 marks. And be very open, you don't need to score 13 out of 13. This, forget it. So don't try to understand each and everything 100%. Write it somewhere. Don't try to understand 100% things of each and everything like exact. No, no. Out of 13 marks, if you score 9, 8, this is excellent. This is excellent. Out of 13, if you score 9 or 8, this is excellent. So, but yes, as a teacher, I'll discuss complete question. I will discuss each and every point. Okay. So don't worry if you have difficulty in 1 or 2 point. It's okay. It's okay. It will happen in the exam as well. When did you score 100 marks in the exam? Is in the exams? Never. So in the exam, you what you do, same technique apply here. That's it. Now, first of all, check the requirement. Go check the requirement of first question. This is the requirement. See, read. Explain. See, this is the requirement. Explain with suitable calculation. Explain with suitable calculations the impact of the three alternative company car option on earning before interest and tax, EBITDA, profit before tax, and the statement of financial position for the year ended. See, three, you need to explain. First of all, explain with suitable calculations as well. So explain plus calculation, and three things: EBITDA, number two, profit before tax, and the statement of financial position, year end numbers. Year end, as a statement of financial position is always as at. Statement of financial position is always as at. Now second thing is, note, candidate should refer to IFRS 16 where appropriate. Yes, you need to discuss openly. Examiner is saying to discuss IFRS 16 accounting. IFRS 16 accounting. Let's move to the question, please. Okay. Okay ji. Now, STEM company, STEM company, STEM company is manufacturing company and is considering providing cars for its senior management. It has also entered into an agreement with two other companies to develop new technology, rough legal entity. Now, emphasis company, the financial year end of STEM company is 31st December X7. Don't forget this year end, 31st December X7. So the first requirement is purely related to IFRS 16, and yes, it is a scoring requirement. You can make good marks from this. Okay. Now just keep a pen with you, and I have also written something with pen, but right now I don't have pen, so only I will refer things. Okay. Now on 1st January X7, STEM company is considering providing company cars to it for its senior management and is comparing three options. The first option is here. Option number one. This is the car can be leased for a period of 4 years. Stop. First of all, we are lessee. We are lessee because we are taking cars on lease. We are taking cars on lease. We are lessee. And I'm sure you all know, for lessee, there is a new accounting standard of IFRS 16. For lessee books, new accounting standard of IFRS 16, the latest accounting standard is applied. Okay. Now, one more thing. In the lessee books, when you have taken it for 4 years, when you have taken it for 4 years, that means it's more than 1 year. That means it's more than 1 year. So whenever it is more than 1 year lease, so you need to record it as a finance lease, and you have to make an entry: ROU, right of use debit, and lease obligation credit. ROU debit and lease obligation credit. I'm sure you guys know this. Okay. And how you make the entry for ROU debit and lease obligation credit? Very simple. Amount of listen, the amount of measurement: present value of future cash flows. Simple. Present value of future cash flows. Present value of future cash flows, not the market value. It's simply present value of future cash flows. Whatever you are going to pay in future, you have to take present value. And the good news is that you will be given ready-made present value in this question. You will be given ready-made present value in this question. You will be given ready-made present value in this question. In this question, you will be given ready-made present value in this question. Okay. Now start reading it. The cars can be leased for a period of 4 years starting on 1st January X7. So it's a finance lease. The cars have a total market value of 75274 on this date. Irrelevant, leave it. The required payments of 1403 on a monthly basis for the duration of the lease term, of which 235 is a servicing charge. Oh, excellent. My dear, first of all, if the transaction is pure pure finance lease, so since you were kids, your teacher used to say this dialogue. Listen, finance lease is like a loan. Finance lease is like a loan. Finance lease is like a loan. So when finance lease is like a loan, so whenever we pay the rentals of finance lease, it's like repayment of loan. Whenever we pay rentals of finance lease, it's like repayment of loan. Okay. And repayment of loan contains two elements. Repayment of loan contains two elements. Number one is the principal repayment, and number two is the interest expense. Okay. So normally, if the rentals are pure finance lease rentals, then it contains two things. Number one is the principal amount, and number two is the interest. But my dear student, there is one more thing included in it. The required payments of 1403 on a monthly basis for the duration of the lease term, of which 235 is the servicing charges. So servicing charges is a normal expense. Servicing charges is a normal expense, and it will go direct in the P&L. If you are paying servicing charges to anybody, it's a normal expense. And it goes directly in the P&L as an expense. Okay. So now let's calculate the pure lease payments. See, 1403, this 1403 is the per month amount. It includes 235 as a service charge. 1403 is the per month amount, 235 is the service charge. So this is the monthly lease rental, pure lease rental. I have removed the service charge. So now this is monthly, multiplied by 12, 14016. So these are the annual lease rentals, 14016, pure annual finance lease rental I have taken out separately. Okay. Now let's take out the service charge also separately. See this. 1 month service charge is 235. 1 month service charge is 235. So how about 12 months? 12 multiplied by 235 is 2280. 12 multiplied by 235 is 2280. Okay. So this 2280 will directly go in PNL. This 2280 will directly go in PNL. Okay. Right now, be active. STEM company wishes to show the servicing charge as a separate line item in the profit and loss. Okay, good. It's expense. Service charge is an expense. Yes, you can book in the P&L. At the end of the 4-year period, still the story is going on. At the end of the 4-year period, there is no option to renew the lease. Okay, very good. Or purchase the cars. Very good. We don't want this car. And there is no residual value guaranteed. No guaranteed residual value. Thank God, no guaranteed residual value. Otherwise, it will be included in the present value of lease payment. Leave it. Now, the interest to be charged for the year ended 31st December X7 is correctly, see the word correctly, calculated at 2274. Interest element is also given. Okay. So I will teach you through entries. Don't worry, I'll remove the screen and I have the basic entries as well. Now, based upon implicit interest rate in the lease, the net present value of the lease payment over the 4 years is 50803, excluding the service charge. That means, see, the service charge is a separate thing. Do not include service charge in this deal. Service charge is a routine revenue expenditure, simple entry, expense debit, cash credit. It has nothing to do with the lease. Please keep it away out of this whole scenario. Okay. Now you have option number one in front of you. Just use your paper and pen. I told you, those who want to do things from basics, keep your paper and pen with you and make entries. You will love it. Please, because I'll move the screen. The first entry, Future cash flows present value. Present value of future cash flows is 50803. 50803. So on the day one, you will be making entry right of use debit and lease obligation credit. Right of use debit and lease obligation credit, right? Okay. One thing more. This 2280 service charge will go in P&L. Now, can anybody tell me how much actual rentals, pure lease rentals we'll pay this year? How much actual lease rentals we'll pay this year? How much actual lease rentals we will pay this year? It will be 14016. It will be 14016. Now, we just calculated, listen. And I told you many times, even your teachers told you many times, listen, that finance, listen, that finance lease is like a loan. Finance lease is like a loan. So paying finance lease rentals is like repayment of loan. Paying finance lease rentals is like repayment of loan. And whenever you repay a loan, whenever you repay a loan, there are two elements. There are two elements in the repayment of loan. Number one is the principal amount, and the number two is the interest. Number two is the interest. So active students, please. The total rentals, the total amount we are paying is 14016. The total amount we are paying is 14016. And out of this total amount, how much is the interest? How much is the interest? How much is the interest? 2274. How much is the interest? 2274. So if you subtract 14016 minus 2274, 14016 minus 2274, you will calculate the pure principal repayment. You will calculate the reduction in your liability during the year, reduction of your lease liability during the year. Okay, so this is how it works. Now giving you 30 seconds to just think over it, then I'll move the screen. 30 seconds to just think over it. Now wait. See this. Just for you guys, I have made these entries. Just for you guys, I have made these entries. Look at here. ROU debit and lease obligation credit. This is the first initial entry on day one. Okay. Now in this question, you guys will read that the, even you have read that the lease term is 4 years. Lease term is 4 years. So you need to, yes, you need to depreciate ROU. You need to depreciate ROU. See, ROU will be depreciated as 50803 divided by 4 years. So 1270 per annum is will be your depreciation expense. 12701 will be your depreciation expense. Okay. Then at the end of the year, make it simple. At the end of the year, you will make this much cash credit. You will make this much lease payment. See this. You will make this much lease payment, total lease payment. So it's 14016 cash credit, and finance lease is a loan. Finance lease is a loan. So whenever you pay the rentals, it like repayment of loan. And in the repayment of loan, there are two elements. In the repayment of loan, there are two elements. One is interest expense and the other is principal. Other is principal payment. So see, cash credit, you are paying rentals, cash credit. This is your interest expense. See, this is your interest expense debit, and LO means lease obligation. LO means lease obligation. Now students, please think. At the beginning of the year, how much was your lease obligation? See my, at the beginning of the year, how much was your lease obligation? It was 50803. At the beginning of the year, how much was your lease obligation? 50803. And it reduced by this amount. See, it reduced by this amount, 11742. So at the end of the year, your lease obligation will be this. At the end of the year, your lease obligation will be this. See, 50803 minus 11742. So this will be 39061, 39061, 39061. Okay, so the whole story, almost the whole story is here. Yes, one thing I have not written, I'll show you that working as well. Just tell me, my dear students, what was the ROU? What was the ROU on the day one? The ROU was 50803. ROU was 50803. And you know, by the end of the year, ROU is depreciated by how much? ROU is depreciated by how much? 12701. 12701. So just think, 50803 less 12701 will give you year-end net book value, will give you year-end carrying value or net book value. So almost all the SOFP and income statement figures are in front of your screen, are in front of your screen, are in front of your screen. Okay. Now, one more thing. As a student, you may ask, sir, what will go in the PNL? Where? What will go in the PNL? Where? Listen. One thing, interest expense will go in the PNL 2274, depreciation expense 12701 will go in the PNL, and service charge 2280 will also go in the PNL. I repeat, I'm just discussion the option number one right now. In option number one, interest expense will go in the PNL 2274, depreciation expense will go in the PNL 12701, and service charge will go in the PNL 2280. Okay. So right now I have just taught you this thing, nothing else, nothing else. I hope and I'm sure you understood it. I'm sure. 11742 is calculated by taking the difference between cash payment and 2274. It's a balancing number. It's a balancing number. Okay. Now, wait. Now let me move. Let me move. Now. Let me move. See this thing, one more thing, other relevant information. I'm not discussing right now immediately the other two options. Let me go in pieces. The profit before tax and profit before accounting for any three options. See this line, the profit before tax and profit before accounting for any three options car is likely to be 100,000. This is the profit for the year ended 31st December X7. STEM company depreciates car over 4-year period using straight line method. Okay. You know what this 100,000 means? Profit before tax means no tax is deducted, and before accounting for any three options. That means in these three options, there is some interest. Yes, there is some depreciation, and there is some operating expenses. In these three options, there is some interest expense. Yes, there is some depreciation expense. Yes, there is some operating expenses. Yes, like service charge. So what they are saying, this 100,000 is before taking anything. That means you have to deduct each and everything from this 100,000 yourself. That means you have to deduct each and everything which I just taught you from this 100,000 yourself. Okay. Okay. Now let me show you for the option number one how we'll deduct it. For the option number one, how we'll deduct it. Don't sleep. Don't sleep. Be active. Be active. Follow me. Follow me. Okay. Okay. See this now. Don't get worried by seeing the full page working. It's okay. It's okay. It's common. Just see the first column. Just see the first column. I'm sure you have written something with you in your with you. Listen, profit before accounting. Only see the first column. Don't look at the second, third column. Leave it. Profit before accounting. Profit before accounting for these things, before accounting for car is 100,000. Now first of all, I have deducted service cost, service charge cost, annual service charge cost. We all just calculated was 2280. The moment you deduct 2280, because this 2280 is like operating expenses, so you will get EBITDA, EBITDA. Sir, why this 97180 is EBITDA? Let me tell you, because EBITDA means earning before interest, tax, depreciation and amortization. Okay. In the question, examiner openly told us, in the question, examiner openly told us that the profit was before tax. Profit was before tax and before accounting for all these options of cars. So before accounting for all these options of cars means before accounting for depreciation, before accounting for amortization, and before accounting for any expenses related to these cars. So that means the moment you deduct the service cost, the profit that will come will be EBITDA, because right now we haven't deducted depreciation, interest or tax yet. We have not deducted interest, depreciation and tax. So this profit 97180 is EBITDA. Use your brain and think over it calm, in a calm way. Will go relax. Now from this EBITDA, now I'm going to deduct depreciation. I calculated depreciation with you guys. Now this depreciation was 12701. This depreciation was 12701. See, 12701. Then interest expense was 2274. So now after deducting depreciation and interest expense, you will come to profit before tax, because now you have deducted everything except tax. Now you have deducted everything except tax. Okay, now a little bit working for SOFPC. This thing, this PPE will go in SOFP. This PPE will go in SOFP. Wait, I just showed you, even you guys told me the numbers. I just told you initially your ROU was 50803. Initially was your ROU was 50803, and in the first year you did this much depreciation. See, in the first year you did this much depreciation, this much depreciation. Okay, so 50803 minus 12701, what will be your year end? What will be your year end NBV? It will be 38103. See, my dear student, my respected student, this is your SOFP number. This is your year end SOFP number. Okay, and one more thing I told you, one more thing I told you, and I have calculated you that lease liability at the year end was 39061. Lease liability at the year end was 39061. I already taught you in the above slides. Yes, I admit in the theory you need to write that this lease liability will be split between current and non-current. This lease liability we need to split between current and non-current, but right now no more information is given. That's why you can't split it. You just need to write in theory. Did you understand this first column? Don't look at column 2 and 3. Leave it. Did you understand this first column? Please write in the comment. Please write, please. Good. Be positive. Think good. EBITDA full name is earning before interest, tax and depreciation. Dear student, I taught this yesterday. Which calculation is wrong? Wait. 100,000 less 2280 is 97120, I think. Okay. This number is wrong, I think. This number is little wrong. This number 97, it will be then 120. Okay. This will be my mistake, but I don't have pen right now. 100,000 less 2280. Wait, let me check. Let me check it for you. Oh no, sorry. Wait, this number is wrong. Sorry. This is 2820. Wait. Oh, wait. This number is I copied. This number is wrong. This is 2820. This number is 2820. Okay, student. This is my copying mistake, but I don't have a pen right now, so I can't correct it right now. Okay, but you do remember this is 2820. Okay. Now, thank you for the update. So it's 2820. It's transposition error 8 and 2. Okay, now let's keep motivation. Let's move to the second and third option, and they are also easy. You will understand. Now option number 2, this is option number 2. The car can be purchased for, what was the market value of the car? Students, think over it. What was the market value of the car? The market value was 75274. The market value of the car was 75274 with 100% bank loan. Okay, now don't think about leasing, just think two entities. See, there is a bank and there is a car shop. There is a bank separate and there is a car shop. Okay, first you went to the bank. First, see, I have made basic entries. First you go to the bank and you take the loan of 75274, because yes, you have to buy the car from market. You have to buy the car from market, so from market you have to pay market value. If you want to buy car from market, then you have to pay the market value. So first let's arrange the cash. Go to the bank and take this loan. Bank debit and loan credit. Student, baby entry, bank debit and loan credit. Okay, now next moment you go to the car shop and you paid this 100,000, sorry, you paid this market value complete. You bought car, the entry will be car debit and cash credit. Car debit and cash credit. Third thing, please be active with me. Now again you have to pay the monthly service cost of 235. Same monthly service cost. Sorry, I skipped one line. The car would be purchased on 1st January X7, that is the first day of our accounting period, and held for 4 years. Okay, 4 years. The estimated residual value, now the residual value is also given, and I'm sure you know how to calculate depreciation using straight line method. Depreciation using straight line method. Now wait. So the loan would be repayable in 4 annual installments commencing from 1st January, from 1st January X8. That means open your eyes. By the end of the year, you didn't pay a single penny. You're not getting. My dear students, see the repayment date. What is the repayment date? 1st January X8, and your accounting period ends on 31st December X7, and your accounting period ends on 31st December X7. So by the end of the year you didn't pay a single penny, you didn't repay a single penny of loan, and there is an interest accrued will be added. You have used the loan for the whole year. Listen, repeat. By the end of first year you didn't repay a single penny to the other party, plus you use the loan for the whole year, so there is an accrued interest as well. So that will be added in your loan, that will be added in your loan liability. So the total liability at the year end, is 75274 plus the accrued interest, which is 5%. Accrued interest, which is 5%. All of you use your calculator. I'm not going to use calculator now. 75274 multiplied by 5%, this is your accrued interest, and this will be added in your loan. This will be added in your loan. Okay, now, so first of all, you've got the bank loan, then you bought the car, and now let's simply depreciate the car. How will you depreciate the car? How will you depreciate the car, students? See, cost less residual value divided by life. See the formula, this formula, cost less residual value divided by life, cost less residual value divided by life. Okay, so this will be 11380 per annum. This will be 11380 per annum. Okay, my dear students, now for this option, don't sleep please. You have to still pay the service charge, same 235 multiplied by 12, same 235 multiplied by 12, that is 2820. 235 multiplied by 12 is 2820. Okay, now second thing which you have to book as an expense is depreciation expense of 11380. Third thing which you have to book as an expense in the income statement is loan interest, which is 5% of the loan, which is 5% of the loan, which is 5% of the loan. Okay, I'm sure you have copied or you have seen all this data. Now please allow me to move to that screen. Please allow me to move to that workings. See, now see the second column. See the second column. First of all, profit before accounting for car was 100,000. profit before accounting for car was 100,000. Again, this number is wrong by me. This number is wrong written by me. This is 2820. This is 2820. First of all, you have to deduct the service charge because it's a pure operating expense. Once you deduct this operating expense, then you will get the EBITDA. See, this 97180, this 97180 is EBITDA, earning before interest, tax and depreciation. Now let's start deducting the two things. The first is depreciation. See, this is the depreciation and this is the interest. 3763 is the interest. Sir, how did you calculate the interest? Sir, how did you calculate the interest? All of you, please take out your calculator. Write 75274 multiply by 5%. 75274 multiply by 5%. So now your profit before tax is 82037. Just use your brain. In the first two options, the profit before tax is almost same. In the first two options, the profit before tax is almost same. Now once again, you have to book in the year end because you recognize the asset and liability. You recognize the non-current asset and liability, so you have to show in the SOFP. In the SOFP, we report non-current asset at carrying value like NBV. So how you calculate the NBV? Cost less depreciation. Cost less depreciation. So this is the first year depreciation. So original cost of this car was 75274 minus 11380. This will be 63894. This will be 63894. Okay, now what will be the loan liability? What will be the loan liability? I already told you, I already showed you, my dear student. This company didn't, in this option 2, we didn't pay a single penny before the year end. So that means the original loan still the same plus the accrued interest. Original loan plus the accrued interest, the total loan will be 79039. Total loan will be 79039. Just an extra thing. Out of these two options, in which option the liability is higher? Out of these two options, in which option the liability, the loan amount is higher? This is the purchase with loan, but second column. So when loan is higher, obviously your gearing will be higher. In the second option, as you are taking more loan, so it will be adverse for your gearing. It will be adverse for your gearing. It will be adverse for your gearing, right? Okay, now this was the option 2. Did you understand? Please let me check. Okay, okay, thank you, please take care. Good. Now the third option is the third option. See, option number 3. You all know this much, IFRS 16. If you buy any asset on lease for less than 12 months, then this is the operating lease and you don't need to recognize any ROU or any lease obligation. Read it. A final alternative is to lease the car within a 12 months agreement on 1st January X7 with no purchase option. Okay, so pure less than 12 months deal. The cost would be 1900 per month, 1900 per month in advance, including service charge. See, this 1900 already includes service charge. But now the good news is you don't need to separate, you don't need to split the service charge and lease payment. You don't need to split service charge and lease payment because this is operating lease. My dear student, option 3 is operating lease, and operating lease rental straight away goes in PNL. Operating lease rental straight away goes in PNL, straight away goes in P&L. Okay, so no need to split. So 1900 is per month thing, multiply by 12 is 22,800. 22,800. Okay, right? So now listen, as in this third case, see, STEM company would take advantage of the short-term lease exemption under IFRS 16. Under IFRS 16, short-term lease exemption under IFRS 16, under IFRS 16. Okay, so now no need to book any ROU, no lease obligation. No ROU, no lease obligation. Listen, when no ROU, that means no depreciation expense. When no lease obligation, that means no interest expense. So in this option 3, there will be no depreciation expense, and no interest expense. Just complete rental is operating expense. Complete rental is one short operating expense. Okay, so let's move to this third part. See, in the third column, look at here. In the third column, please student, look at here. Profit before accounting for all cars was 100,000, and you have to deduct simply in one shot. It's an operating expense. It's an operate. Now you have only operating expense, no depreciation, no interest, nothing. So in one shot you deduct 22,800. So your EBITDA is 77,200. EBITDA went down. See, EBITDA went down because EBITDA is profit before interest, tax, depreciation and amortization. But now you don't have any depreciation and amortization, and you booked everything. You booked everything before EBITDA. So definitely your EBITDA went down in this case. But as compared to other case, the EBITDA is high. Okay, now see, in this case there is no depreciation, there is no interest, so your profit before tax will be 77,200. And now see the SOFP. Nothing will go in SOFP, because in this case you did not recognize any non-current asset at the beginning, no ROU and no lease obligation, so liability and everything will go 0, 0. Liability and everything will go 0, 0. That's it. Now this was the major table for this question. If you understand this table, you simply have to write according to this. That's it, in very simple words. Now wait, if we talk about EBITDA, if a company wants higher EBITDA, if there is a company whose performance is checked by the user using EBITDA, so which option they should choose to increase the EBITDA? Definitely first or second. First and second option is good for EBITDA. First and second option is very, very good for EBITDA. Okay, right? Are you getting? But yes, again, one more thing, let me tell you. Have you ever heard about in your basic studies F7 FR level, you know the ratio asset turnover? Have you ever heard about asset turnover? Take out your pen and write the formula. The asset turnover is equal to sales divided by total assets. Write this formula: sales divided by total assets. Asset turnover is equal to sales divided by total assets. Okay, now listen. Total assets are coming in denominator. So if your denominator will go up, your asset turnover will go down. I repeat, write the formula: asset turnover is equal to sales divided by total assets. Okay, sales divided by total assets. So if total assets are coming in denominator, so now just think, if your total assets will go up, your asset turnover will go down. And in option number 1 and 2, see, in the option number first and second column, there is a PPE. See, there is a PPE. That means there is a non-current asset balance. So in option number 1 and 2, there is a higher balance of asset. So option number 1 and 2 is adverse for asset turnover. Option number 1 and 2 is adverse for asset turnover. Think over it, please. You can think now. You have paper after 15-20 days. But in option 3 there is no asset. See, in option 3 there is no asset, so option 3 is good for asset turnover. Option 3 is good for asset turnover. Think over it. Similarly, in option number 1 and 2, in option number 1 and 2 there is a lease liability. In option number 1 and 2 there is a lease liability. Okay, so option number 1 and 2 is not good for gearing. Option number 1 and 2 is not good for gearing ratio, but yes, in option number 3 there is no liability. In option number 3 there is no liability, so option number 3 is good for gearing ratio as well. Option number 3 is good for gearing ratio as well. Okay, did you understand these things? So I would say, now I won't ask did you understand. Did you understand 70% of this topic? That's more than enough. Did you understand 70%? Okay, thank good. 70% is the target. 70% is the target. No more 100%, no more 99, 95. Sorry, 70% is excellent. Now we just have to write whatever we discussed. We just have to write in simple words. Simple words, you whatever we have discussed. Okay, right? Just want to show you one thing last in the end. Can you see this connection? This connection, see the original liability. Take out your calculator. 50803, 50803, and I have directly subtracted 11742 from 50803. I have directly subtracted 11742 because I made the entry for you. From 50803 I have directly subtracted 11742 so that you get this number. Okay, but you know examiner, how examiner speaks. Wait, take out your calculator. First of all, write 50803 and subtract this amount first, 14016. 50803 less 14016 and then add interest. 50803 less means subtract, less 14016 and then add 2274. You will get the same number. It's the same technique. Either you can do 50803 less 11742, you will get the year end liability immediately, or you can do 50803 less 14016 plus 2274. My respected student, these two strategies are same. The wordings we may use may be different, but these two are same thing. Okay, you can use any wordings. Okay, let's see how to discuss. See, this is the first treatment. This is the first treatment, and you have to write in simple words. Treatment option number 1, C, leased for a 4-year period, a right of use of asset and as lease liability of 50803 would be recognized. Yes, ROU debit and lease obligation credit we just did with the present value. Okay, now the annual lease component of the lease payment, pure lease payment, remember 1403 less 235, we remove the service charge. I did in with you and multiply by 12, so it will be 14016. We already did this, please, we already did this. And the service component is 2820. This is 12 times 235. At 31st December X7, operating expenses will comprise the service component. Yes, depreciation is also an operating expenses. Yes, and interest 2274. These three things will go in P&L. These three things, as I told you using entries, as I told you in the above sheet, that depreciation expense, interest expense and the service charge, these three things will all go in P&L. The lease liability recognized will be 50803. Yes, at the day one the lease liability is 50803, and then you can add 14016, sorry, less 14016 plus interest. You will get 39061, or you can use my shortcut. Remember my shortcut with entry, both are correct. The closing lease liability will be split. You have done the basics, you have seen the lectures. At the year end, you split the lease liability between current and non-current, current and non-current. Okay. IFRS 16 requires a company to recognize interest on lease liabilities separately from depreciation. Yes, depreciation is a separate expense, interest expense is a separate expense. Interest expense is part of finance cost. Interest expense is part of finance cost. Now, my dear student, these are normal discussion. No, this discussion is not abnormal at all. Means whatever we were doing, we just have to write in simple words, and yes, your wordings may be different, this is totally fine, Okay. Treatment number two, remember we bought car on loan. We first took loan and then we bought car. So first we took loan of 75,000 something. See, purchased on 1st January X7, if the cars were purchased on 1st January X7, the depreciation would be this much. See, even I used the baby formula, cost minus residual value divided by life. Remember, cost minus residual value divided by life. This depreciation we have already calculated, and interest we calculated on 75274, this thing, right? The car would have to be serviced at a cost. Yes, again in the question it was written that the service there will be a service charge as well. So just for your recap, in this option again you have three expense. In this option again you have three expense. In this option again you have three expense. The first is depreciation, the second is interest expense, and the third is service charge. Again same. Option number three, see, these are the basic discussion of IFRS 16. Leased on 12 months agreement, instead of applying the recognition requirement of IFRS 16, we are not going to recognize it. Recognize means ROU debit and lease obligation credit. A lessee may elect to account for the lease payment as an expense on a straight line basis over the lease term. Now you can simply book expense debit and cash credit. These two are the options. Leases with a lease term of 12 months or less and containing no purchase options. And number two, low value asset. Remember, low value asset. You can also get exemption on low value assets as well. Okay. So as in the question, we are not doing anything. In the question, examiner has asked you to apply exemption, in this option 3. So you did apply the exemption. Okay. Now, impact, listen, the effect of applying IFRS 16 exemption would be that neither an asset nor a liability will be recognized. Yes, if you apply exemption, then no ROU, no lease obligation, nothing in the statement of financial position, neither a right of use. Yes, if this exemption is applied, instead an expense will be recognized in the profit and loss. So simply 12 multiplied by 1900, 12 multiplied by 1900, straight away 22,800 for the whole year will go in P&L. Operating expenses will be debited by 22,800. This is the impact of this third option, which was exemption. Now, hope you remember the requirement. I first read the requirement. Remember, I first of all I started the question with requirement. My respected students, hope you remember the examiner asked the impact of these three on EBITDA. This is typing mistake. EBITDA, it's not this spelling. The spelling is wrong in the heading, so it's EBITDA. Now it can be seen that the impact on EBITDA is greatest if 12 months lease are the third option. In the third option, we just saw the lowest EBITDA. We just saw the lowest EBITDA because the major expenses were booked before EBITDA. This is because the cost is shown in operating expenses. Yes, you booked everything in operating expenses. Additionally, profit before tax is also lower under this option. EBITDA does not include lease interest when IFRS 16 is used, and thus it's naturally higher. Listen, in the option number 1 and 2, there was some interest as well and some depreciation as well. There was some interest and depreciation as well. And EBITDA, yesterday we also, EBITDA never includes these two. So definitely in option number 1 and 2, you will find higher EBITDA. You will get higher EBITDA. You will get higher EBITDA. Now, impacts. So listen, the carrying amount, sorry, I missed one para. Yes, if 12 months leases are chosen, then there will be no recognition of an asset or for the car, which will result in a higher asset base for the 4-year lease purchase of cars, which will affect the ratios such as asset turnover. Yes, I taught you this. In option number 1 and 2, you will have a higher amount of assets, because in option number 1 and 2 you were recognizing assets. So definitely it will impact your asset turnover adversely. It will affect your asset turnover adversely. I just taught you, remember I taught you this. And then a 12-month exemption good for gearing. One more thing I have added, in option number 1 and 2, there will be impact on gearing as well. But in option 3, your gearing will be fine. I taught you this, students. I discussed this. Now, IFRS 16 treatment number 1, the carrying amount. Now you need a little energy, please, little energy. And if you don't understand, no issue. If you have understood the question till now, you have scored 10 marks, 9 to 10 marks you have done. These are extra marks. Just think, the carrying amount of the leased car will be typically reduced more quickly than the carrying amount of lease liabilities. Stay calm. Wait, the carrying amount of leased car will typically reduce more quickly than carrying amount of the lease liabilities. This is because in each period of the leased car is depreciated on a straight line basis. On the other hand, lease liability is reduced by the amount of lease payments made and increased by the interest, which reduces over the life of the lease. Slow. First read it and think. I'll show you some entries as well. I'll show you the entries. Now, just for you guys, I have used some imaginary numbers, and even these things you guys study in F7 FR level, and sometime teacher teaches in SBR as well. Sometime. Let me show you something for you. Wait, it's on the, yes, see this. Do you remember this lease amortization schedule? I have made this imaginary lease amortization schedule for you guys. I have made this imaginary lease amortization schedule. In finance lease, you guys used to make this date, rentals, finance chart, decrease in lease obligation, and balance lease obligation. Remember in finance lease, you guys used to make this. So now use your brain. Initially your lease obligation was 50803. In the first year, this was your total rentals and this is your interest. but you know, you don't decrease your liability with the complete rentals. You don't decrease your liability with the complete rental. You first take the difference. You first take the difference between these two, and then you reduce with this amount. So that means initially your liability was 50803 and it decreased by this amount. So year end liability is this, year end liability is this. But you know, the ROU side, in the ROU side, you straight away deduct the depreciation. You straight away deduct the depreciation of 12701. So just think, in the first year you booked, you reduce your liability by 11742. You reduce your liability by 11742, but your asset went down with more pace. Your asset went down with a bigger pace. So in this way, your carrying value of asset is going down with more speed, but liability is not going down with that speed. Just think, this second year, these are imaginary numbers. See, I have taken imaginary numbers in the second year. I have taken imaginary numbers in the second year. These are not given in the question, please. These numbers are totally imaginary numbers. So this thing is written by me in the solution I just showed you, that the asset goes down with higher pace, but the liability goes, comparatively liability goes slowly. Liability goes down slowly, liability goes down slowly. Okay, so what will be the impact on the equity? Let me show you. What will be the impact on the equity? Let me show you. See this, see this. C is equal to A minus L. See, the liability is going down with a slower pace, but the asset is going down with a higher pace. So asset will be more lower, so finally your equity will be lower. Your equity will be lower. Just think, C is equal to A minus L. Capital is equal to assets minus liabilities. Liabilities going down slowly, and assets is going down fast comparatively. So ultimately the value of your assets will be much lower than the as value of your liability. So your net asset will be impacted negatively. Your net asset will have a negative impact. Think over it. It's technical, I know. It's technical. This is what is written. The carrying amount of the leased car will typically reduce more quickly than the carrying amount of the lease liabilities. This is because in each period of the lease, the leased car is depreciated on a straight line basis. Lease liability is reduced by the amount of lease payment made and increased by the interest, which reduces over the life of the asset. Every year the interest expense goes down. The amount of the lease asset and lease liability are the same at the start. On the day one, they both were same. At the day one, we made the entry ROU debit and lease obligation credit. They both were same. The amount of the asset thing would typically be lower, than that of a liability throughout the lease term. This will result in the further reduction in the reported equity as compared to 12 months lease. As compared to 12 months lease, the equity will be more down. The equity will be more down. So those companies who wants their equity or net assets to be higher, they should go for option number 3. Those companies who wants their equity to be higher, they should go for option number 3. They should go for option number 3. Okay, so this will impact your equity or net assets adversely in starting options. Okay, I know this is a bit technical, but if you think over it, you will understand. If you think over it, you will understand. My dear student, please, first of all, let me, asset is going down with higher speed, liability is going down with lower speed. because whatever rentals you are paying, you don't deduct the complete amount from the liability. There is one thing which is interest. C is net assets. C means capital. C means capital. C means capital. C is equal to A minus L is it means capital is equal to asset less liabilities. And capital means equity, and capital also means net assets. Now, let's move to the second part of this show, and which is, now wait, you might have studied, listen, IFRS, you might have studied IFRS 11, joint arrangement, joint operation and joint venture, joint operation and joint venture. We'll have a recap of this as well here, and then we'll have something about equity accounting general discussion, no more advanced level things, okay? And finally something about associate also. Now, discuss briefly. First of all, read the requirement B part 1. B part 1. Discuss briefly. Now wait, why I'm discussing this requirement? This is a general requirement. This is totally a general requirement. Just make up your mind. Discuss briefly principles of the equity method of accounting and whether it is more relevant measurement basis than cost or fair value for an investment of in an associate company. Don't take tension, go relax, very relax. You know, when you buy 30% shares of a company and you get significant influence in that company, then you do equity accounting. Then what you do, this is equity accounting. And how you do equity accounting, listen, COI, cost of investment, add post profits of that company, multiply by your share, add post profits of that company, multiply by your share, right? And you report this is in one line, because equity accounting does not mean adding together. Consolidation is a separate thing. Whenever you get control of an entity, you do adding together. Whenever you get control of a certain entity, you do adding together, right? But if you don't have control, you just have significant influence, you just have what? Significant influence. In that case, you just do COI, cost of investment, add post profits of associate company, multiply by your share, and you just report it in one line. Now, this is what we call equity accounting. Now tell me, listen, whether it is more relevant, see the word, whether it is more relevant, just think relevant means useful for shareholders, then cost or fair value of an investment in an associate company. Now listen, yes, it is better than original cost. If you report this investment at original cost, then that will be outdated. Why? Because in equity accounting, as you are the owner of that company, for example, I have bought 30% shares in associate. That means I am the 30% owner. I am the 30% owner of associate. So if the performance of associate is going up or down, like the profits of associate is going up or down, so it should be reflected in my books. And yes, this reflection is done. Using equity accounting. So yes, it is better than cost. Okay, right? Now compare it with fair value. Listen, fair value has its advantage and has disadvantage as well. Listen to me. If you record it at fair value means stock market value. So there is no guarantee that the profits are already recorded, in the fair value. But as compared to equity accounting, you properly record the profit share. Number two, if you record it at fair value is a pure judgmental based thing. I hope you remember IFRS 13. In fair value, you need to apply level 1, level 2, level 3. There are a lot of things. There are a lot of judgments. So whenever there is a judgment comes, whenever there is a judgment comes, the reliability of books goes down. The reliability of books goes down. So in terms of fair value accounting, there is a judgment element is also there. And yes, if that company is listed company, if that company is listed company, then fair value is very easy and accurate. If that company is listed or stock market companies, then you can easily calculate the fair value through stock exchange. But what if that company is unlisted company, then this will be very difficult. Then this will be very difficult. Then this will be very, very difficult, right? So you just have to write, you just have to define see briefly, discuss briefly principle of equity accounting. First of all, you need to define how we do equity accounting. Then after that, you need to compare it with cost and fair value, just 4 marks. You need to compare it with cost and fair value, just 4 marks. That's it, that's it. And this is general discussion, not linked to this question, not linked to this question, general discussion. Okay, see the exam, there is no need to refer any exhibit when answering this. See this, see this note, see this note. There is no need, there is no need to refer any exhibit when answering part B of this note. Okay, let me show you. Okay, please, this is what the answer is. The equity method is is a measurement method and not a consolidation method. It's not consolidation, it's not adding together. As equity accounted entity remains as a single line in the investor's statement of financial position and IFRS standards, consolidation is based on the existence of control. Yes, you do adding together when you have control, but when you have significant influence, you just do equity accounting. Now, equity accounting is a measurement method for investments where there is a significant influence and recognizes associate profit which have not been received and could not be successfully demanded, now wait, you know, you have 30% shares but you cannot take out in the form of dividends. You cannot, you don't have control, that's why the word successfully demanded is written, right? Now, equity method, provides better information. Equity method provides better information that provided cost, but it then that provided by cost. Yes, first of all we need to compare it with cost. So it's better than cost because it, the cost is, outdated thing. Historical cost means like you bought 3 years back, like you bought these shares 3 years back, so now the values are changed, the performance is changed. So it's better you use equity accounting because equity accounting at least includes the performance of associate. Equity accounting at least includes the performance. But it can be argued that where investments are listed, then there is no reason not to use fair value. Yes, when it is a listed investment, then the fair value is excellent, because fair value gives you the real picture. However, if an investment is listed, then its fair value would be easier to establish and more appealing than the numbers derived from the equity method. If the associate is unlisted, then there might be questions about the verifiability of fair value. Then this fair value will be totally judgmental, right? So yes, if that associate is listed, then it's very easy to calculate fair value, and yes, fair value gives you the real picture. But if it is unlisted, then it would be very difficult, to say that this fair value is real or not. Then it will be a judgmental based thing. Okay, now I want to give you one more aspect of equity accounting. It is not asked in this question, but yes, in 10 to 12 years back it came in your FR paper. 10 to 12 years back it came in FR paper, that the criticism of equity accounting, what is bad in equity accounting? Listen, in equity accounting, look at here, You just write one line. You write carrying value of investment and associate in your balance sheet. In your SOFP, you write only one line for that company. Only one line for that company. You don't do top to bottom adding together. In consolidation with subsidiary, you do top to bottom adding together. But in equity accounting, you just report the complete investment in single line. And when you report anything in one line, many things are hidden then, many things you hide then, many things are not reported accurately. What is the logic? Let me give you one practical example. Yes, listen, this example. Assuming one of my student needs a job. One of my student needs a job. Listen, I told that guy, yes, I have a job in a company, and you have to just manage a working capital of 3 million. First of all, the formula of working capital is current asset less current liabilities. Current asset less working capital is current asset less current liabilities. So one of my student asked you, sir, I want to do job. So I said, okay, can you manage working capital? He said, yes, I can manage working capital. So you know what I told that guy? I have a job, and in that company you have to manage just 3 million working capital. You have to manage just 3 million working capital. Now what that student was thinking, that the working capital means current asset minus current liabilities, current asset minus current liabilities. So 3 million means 4 minus 1. There will be 4 million current asset and 1 million current liabilities. Okay, so I told him, okay, just you just have to manage 3 million working capital. You just have to manage 3 million working capital. So he agreed on a very low salary. He agreed that job on a very low salary. But the moment he entered in the company, he found this. The moment he entered in the company, he found this: working capital is 3 million. Correct, working capital is 3 million, but how this is calculated? 100 million current asset and 97 million current liabilities. 100 million current assets and 97 million current liabilities. Yes, 100 minus 97 is also 3, and 4 minus 1 is also 3. But there is a big difference between these two companies. Managing this company is hell. So whenever you judge things with a single figure, you get distracted, you go in the wrong direction, you take wrong decisions. You're not getting my point. Whenever decisions are taken on the basis of single figure, see working capital 3 million, that guy was thinking that I will go in this company 4 minus 1, but we sent him in this company 100 minus 97. Although the end figure 3 million is same, working capital 3 million is same, but there is a big difference between these two companies. So same is the problem with equity accounting. Equity accounting is also one line thing. Equity accounting is also one line thing, and this one line thing sometimes creates difficulty in understanding the reality of that project. So this is the criticism on equity accounting. Did you understand this last criticism? Please tell me. Got it? Now please don't expect 100 marks. You all, I know you guys. You guys expect 100 marks, and you guys want to understand each and everything crystal clear. No, this is a technical paper. Be happy with 70% understanding. Say thank God. 70% understanding is very good. We don't want 100% understanding. First make this mind. During article reading, during solving questions, please don't expect 100% accuracy. 70, 65 is good. Okay, now let's take a break, and then I'll discuss the remaining part. We are going to take 15 to 20 minutes break, and then we'll join. Okay, come fresh. Thank you. Okay. Okay, students. Now we are moving towards the remaining part. Okay, this first of all, there is a standard IFRS 11 joint arrangement. Joint arrangement is applied first thing when you have joint control, when parties, investors have joint control. Joint control means unanimous consent. Unanimous consent. For example, there are three people, and if they claim they have joint control, means we need yes from three of them, we need vote from three of them in order to change anything, in order to implement any significant decision, any significant thing. Okay, so we need vote of from all three of them. If one of them say no, that means that thing cannot be changed. So the basis of this IFRS 11 is joint control. Joint control, this is must. Now there are two types of arrangement, joint arrangement. One is joint operation and second is joint venture. In joint operation, normally we don't create a separate entity, separate legal entity. Normally what the investors do, they bring their own assets and they share their assets, they share the revenue, they share directly the revenue, they share the cost. For example, there are three teachers. One teacher owns office, one teacher has premises, the other teacher has furniture, and the third one has marketing skills or some other skills, right? Now they combined it, and now they distributed the time, and they distributed the revenue, they distributed the total cost. So such arrangement is called joint operation. Okay, and in this joint operation, you directly, in this joint operation, right now in this question there is no joint operation, it's joint venture. In joint operation, we directly own the assets, we directly, the parties have direct interest in the assets. They are responsible directly for the liabilities, and for the accounting treatment, what they do, they directly book the revenue, cost, the asset share in their own books, simply. But on the other hand, joint venture, in joint venture you create a separate entity, and the shares and the holdings are distributed through shares. That means investors hold shares. And now investors does not own the assets. Investor does not directly own the assets, they own the shares. They have rights in the net assets, not assets. And they are not going to get the direct revenue share, they are going to get the profit share, the final bottom line profit, like shareholders. So in joint venture, normally a separate entity is created, and the shares are distributed among shareholders, and they have rights in the net assets, not assets, only net assets, right? And they get the share of profit, not the share of revenue and cost. Okay, right? So these are the indications. Now if in the end you conclude that your investment is joint venture, for example, if in the end you conclude that your investment is joint venture, that means you have invested in joint venture, then my dear students, you have to do equity accounting in your books. According to the treatment of IFRS, you need to do equity accounting, the same associate equity accounting you need to do same associate equity accounting. Okay, now, so just think, there are two parts of this question. One is about whether this is joint venture or not, and the second thing is some new thing here, some new thing. I'll explain you, don't worry. On 1st January X7, STEM company has contributed cash in a new legal entity, separate legal entity, that is Emphasis Company. Emphasis Company, okay, holds an interest of 40%. That means we own 40%. STEM company owns 40%. Okay. Now the other two companies contributing have retained equity of 40 and 20. That means there are three owners, 40 STEM company, 40 another guy, and 20 another guy, okay, respectively. The purpose of the entity is to share risk and reward in developing a new technology. Together they are developing a new technology together. The holders of a 40% interest can appoint 3 members each to 7 members board of directors. The board of directors, there are total 7 guys will sit, 7 people will sit in the board, and those who hold 40% shares, they will have 3 out of 7, they will have 3 members. So that means 3 board members will be sent by STEM company, 3 members by the another 40% guy, and 1 member by the 20%. Total 7 members, 3, 3, and 1. Okay, now let's see what is the deal, how board will work. See, all significant decisions. See, the real decisions are significant decisions. The real decisions are material significant, require the unanimous consent of the board. That's it. Finish. Now put all the legal holdings in the dustbin. This is the real word. See, all seven board members must give vote for a decision making. That means all three has joint control. It's a proper joint control. Yes. The holder of the 20% interest can appoint only one board member. Yes, one board member is effective and can only participate in significant decisions. Yes, the real decisions are significant decisions. The real decisions are significant decision. Immaterial and insignificant decision, nobody care about it. Nobody cares about insignificant decision. Leave it. Real decisions, real power, insignificant decision of the entity through the board. There are no related parties. Okay. So what is the setup? The new company's form, which is Emphasis Company, 40% is held by STEM, 40% is held by another guy, and 20% by one more guy. What is the composition of board? There will be total seven board members. 3 belongs to STEM, 3 belongs to other guy, and 1 belong to that 20% holding. Okay. Now, do you think the 3 of them has joint control? Yes, 3 of them has joint control. Why? Because of this line. Because of this line. This line. All significant decisions required the unanimous consent of the board. Unanimous consent of the board means all 7 members must give vote, and out of these 7 member, 1 member belongs to that 20% guy. So this 20% guy also has joint control, because if he says no, nothing will change. No, they cannot pass anything. They cannot pass any major decision without the consent of this 20% guy. So in economic reality, listen, legal holding does not matter. The real thing is decision making power. And yes, unanimous consent is with complete board. That means that this one board member can also stop things. Okay. The holder of the 20% interest can appoint only one board member and can only participate and can only participate. See the technique of the examiner. Just think, examiner is so sharp. He's saying that 20% interest can appoint only one board member. One is enough. Because one can pull the chain. One guy can pull the chain. See the unanimous consent. And then they are saying can only participate in significant decision. Significant decision. Do you think it's only thing? Significant decision is a big thing. Significant decisions are real decisions. Significant decisions are real decisions. Big decisions. So when you have power to stop the big decisions, yes, you have joint control. So I think this paragraph was not difficult. This paragraph was a routine paragraph for a student, and this is scoring. Yes, this paragraph is a new thing. Examiner tested this first time in the history. This paragraph is tested first time in the history. This is a new thing. This is a new thing. No issue. But in the first paragraph, you can easily score the marks. Okay. So what they are saying in the requirement, see, they are saying discuss why STEM companies investment in emphasis company should be classified as a joint venture. Yes. And how STEM company should account for the interest on 1st January X7 in accordance with IS 28. Yes. For for joint ventures, you have to do equity accounting. For joint venture, you have to do equity accounting. For joint venture, you must do equity accounting, and that we'll deal. That we'll deal. Don't worry. First of all, let's just see this first requirement. The first thing. Okay, this is. I've just written with the pen. Joint venture is interest in net assets. I told you orally. Okay. Now, joint ventures are, yes, joint arrangement which are usually structured through a separate vehicle, separate company, which confers legal separation between joint ventures and the assets and liabilities in the vehicle. Now, wait. Hope you remember the concept of limited company. Hope you remember the concept of the limited company. Limited company. In limited company, shareholders are separate and the company is separate. In the basics of your accounting, you have studied the concept of limited company. Company is separate and shareholders are separate. That's what they are saying, that there is a legal separation between joint venture and the assets and liabilities in the vehicle. Vehicle is a separate thing. Okay, separate company will be formed. The entity must be under joint control of the venturers. Yes, they have joint control. The investors have joint control, which is the contractually agreed sharing control of an arrangement, which exists only when the decisions about the relevant significant activities require the unanimous consent of the parties sharing control, right? I give you one practical thing of my own life. Whenever somebody tells me to join in a partnership of 3 to 4 people, any partnership, I always write this clause for me, unanimous consent, that I will you have to take vote from me, and if I don't give vote, you can't change anything. This is very important thing in practical life as well. Very important thing in practical life as well. The ventures must be able to exercise joint control of the entity. These are very simple discussion. Now let's simply do application, giving you just 30 seconds to read these 3 points again. Now, application number 1. Emphasis company is a joint venture. Yes, you have openly told. Its activities are conducted through a separate legal entity. Yes, in the question we read. And the parties participating in the decision making exercise control through their equity investment. This control is determined by the ability to appoint the board members. Yes, you will send your board members, and yes, board members have unanimous consent thing. This means that the significant decisions required the unanimous consent of all of the parties, including that 20% guy. The company holding 20% of the equity can only appoint one board members, but does have ability to prevent the remaining companies from making significant decisions without this consent, without its consent. This is the real point. That 20% guy can stop the whole train. Okay, so that's why this 20% guy also has joint control. So this thing you have to write for this opening paragraph. You have to write these things. I'm not moving for the next thing. I'm not moving on for the next thing. Did you understand this part? Please tell me. This was easy part. One student has asked a question that the holding should be 33, 33, 30. No, 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 no. It's not written in any IS. 33, 33, 33. Not necessary. Not necessary. Okay. Holding percentage does not matter. Does not matter. Real thing is agreement. The economic reality. Try to go with the economic reality. I'm sure you all have studied a concept, substance over form. Substance over form. Substance over form. This is a very, very basic concept of accounting, and it comes in almost all standards. It applies on almost all standards. You have to see the economic reality of the transaction. You have to see the economic reality of the transaction. This is not joint operation. Why? Because joint operation is not normally not operated through a separate vehicle. In joint operation, normally the shares are not distributed. The parties directly owns the assets, directly owns the asset. They don't own the shares. They say this building is mine, this furniture is mine. Now, before we move on to the next area, first I'll teach you some basics. First, I will teach you some basics and try to listen. For example, okay, now listen. First thing, whatever it is written in front of your screen, it's about associate. And yes, it is a non-routine area. It happens sometime examiner asks you non-routine things. It happens sometimes examiner asks you non-routine things. Now student will say, sir, we were not ready for that thing. Okay, it's 3 marks. It's 3 to 4 marks max. What about the 96 marks of the paper? Go clear your paper with 96. Plus, still, if you get something new, try to give your suggested solution. Suggested solution. Give your suggested solution. That's it. Now, first of all, let me start my discussion with control. You know, when you have a subsidiary, when you acquire a subsidiary, you compute goodwill on the day one, assuming the holding is 100%. Simple. Assuming the holding is 100%. Listen, if you want to write the numbers, you can write. Otherwise, listen very carefully, you will understand. For example, your COI is 100,000. Your COI is 100,000, but the fair value of net assets of S company is 80,000. COI is higher, fair value of net asset is lower. You will have a 20,000 goodwill. Goodwill. I repeat, simple consolidation case. You are computing goodwill. You are holding is 100%. Simple 100%. Your COI, cost of investment, is 100,000 and the fair value of net assets of subsidiary is 80,000. So obviously at the bottom line you will get 20,000 goodwill because you are paying more than fair value. Okay. Now the second case, I'm talking about subsidiary. Your COI is 100,000. Your COI is 100,000, but the fair value of net asset is 120,000. COI is 100,000, but the fair value of my dear student net asset is 120,000. So there will be a gain on bargain purchase. Some people call it negative goodwill, but the real word is gain on bargain purchase. Okay, you got it. Now the exact accounting is applied in associate as well on initial recognition. This exact accounting is applied on associate equity accounting. Now you will get shocked. You will say, sir, what you are saying? What you are saying? We have not seen, we have never seen in all our exam kit. If you see 100 questions or in F7 level Associate, you teachers say COI in associate. What, how we do equity accounting? Listen, COI, cost of investment, add post profits of associate company, multiply by the profit percentage holding. Repeat, how we do equity accounting? Cost of investment, add post profits of associate company, multiply by the holding percentage. That's it. So initially it is recorded as cost. COI is the cost. COI is the cost. My dear student, yes, in your 99% kit you have studied this thing. You have studied this thing. I agree. I agree. But the problem is, in the exam kit question, there is one assumption that your cost of investment is exactly equal to the fair value of net assets of associate. This cost of investment is exactly equal to your share of fair value of net assets of associate. That's why there is no need, there was no need previously to calculate any goodwill or gain on bargain purchase. There was no need to calculate any goodwill or gain on bargain purchase. The way I taught you the subsidiary, the same thing is done here as well. The same thing is done here as well. Now, let me give you one example. Let me give you one example. Listen, this is the first example. The first example relates to our question, the question which we are doing right now. Listen, you know, we bought 40% shares. We are a STEM company, and STEM company bought 40% shares of this new company. STEM company bought 40% shares of this new company. We paid COI of this. See, we paid COI 150,000. The carrying value of net asset is 310,000 at the date of this 40% buying. Leave this carrying value, the real thing is fair value. The fair value of net assets is equal of this complete company. The fair value of net assets of this complete company is 470. What is your share? 40%. See, what is your share? It's 40%. So 470,000 multiplied by 40%. 470,000 multiplied by 40% will give you 188,000. 470 multiply by 40% will give you 188,000. Now just think, you paid how much? You paid how much? 150 for the 40% company. Open your eyes. For the 40% company you paid 150,000, and how much you get? How much share of fair value of net asset you get? 188. Oh, that means a thing, a share which worth 188, a share which worth 188, and you got it for 150. The worth of that share was 188 and you got it for 150. So you have, this is a gain. This is a gain for you, and yes, this is gain on bargain purchase. So what will be the entry? Listen, you will recognize your investment at fair value. You will recognize your investment at fair value of net asset share. So debit investment by 188. Your share, the worth of your share, the worth of your share is 188. Investment debit 188. How much cash you paid? How much cash you paid? Please don't sleep. How much cash you paid? 150. And the remaining 38,000 is gain on bargain purchase. And yes, gain on bargain purchase immediately goes in PNL. Gain on bargain purchase immediately goes in PNL. Immediately goes in PNL. So this is the treatment. This is the treatment when at initial recognition. When at initial recognition, there is a difference between, there's a difference between your COI and the fair value of net assets share. Fair value of net assets multiply by your share, then you have to book a goodwill or gain on bargain purchase. Then you have to book a goodwill or gain on bargain purchase. Now you will ask, sir, but we didn't do this before. Yes, it was not tested before. It was not tested before, but yes, it is tested now. But if you read the IFRS book, you will find this concept. If you read the IFRS book, you will find this concept. Now, the moment I taught you this concept, you as a student, you will ask the second question, sir, what about if the fair value of net asset is lower and the COI is higher? If the fair value of net asset is lower and the COI is higher, so there will be a goodwill. There will be a goodwill. There will be a positive goodwill. But now we haven't seen any goodwill in associate for associate books. So what is the treatment? See, let us say today you bought a, now this, in this example I'm using 30%. I'm using 30%. Okay, let us say our holding is 30%. This is a separate example. You just bought 30% shares for 150,000. You just bought 30% shares for 150,000, and the fair value of net assets of associate at this date is 300,000. The fair value of net assets of associate as at this date is 300,000, and your share is 30%. This is a new example. So 90,000. So for 90,000 worth of company, 90,000 worth of share, you paid 150. 90,000 worth of share, you paid 150. So technically you paid 60,000 goodwill. Use your brain. For 90,000 worth of a company, you paid 150,000. You paid how much? 150. So technically you paid 60,000 goodwill. So I know what entry you are expecting. This entry you are expecting. See, you are expecting this entry. See this entry. Cash, you paid cash 150. You paid cash 150. Investment debit 150 and goodwill debit 60. Goodwill because you paid goodwill. But see what I have written here. Cross, don't make this entry. Standard says simply make directly this entry. Investment debit and cash credit means include the goodwill. Include the goodwill inside your investment. Include the goodwill inside your investment. This is the correct entry. This is the correct entry. Yes, you recorded the goodwill. Yes, you recorded the goodwill the way you record in consolidation, but you include it in this investment. You include it in this investment. You include that goodwill in this investment. And same thing, listen, and same thing you were doing here. This 38, see, this 38 is also included in this investment. This 38, how this 188 became 30 plus 1, 38 plus 150, 38 plus 150. So in both cases, whether a positive or negative goodwill arises, it becomes part of investment. Whether a positive or negative goodwill arises, negative goodwill means gain on bargain purchase. Whether a positive or negative goodwill arises, it becomes the part of your investment. It becomes the part of your investment. It becomes the part of your investment. I have written this line as well of IS. I'll show you. See this. See, means positive or negative amount of goodwill is included in the carrying amount of investment in associate. These are the words of IS 28. These are the wordings of IS 28. Means positive or negative amount of goodwill is included in the carrying amount of investment in associate. And for your information, if you are active, you remember this same treatment is in IFRS 3 consolidation. In consolidation, whenever you get a gain on bargain purchase, you book in P&L. Whenever you get a gain on bargain purchase, you book it in P&L. And whenever you get positive goodwill, you record it as an asset. Same is the case here. You record it as an asset. You record goodwill as an asset. Yes, you included it in investment. You included it in investment. Okay, so now let's read the last lines. Let's read the last lines, please. And I'll talk some practical things as well, some business points. Yes, see this. STEM company, read this point. Now you will understand. STEM company contributed cash. STEM company contributed cash of 150,000 to Emphasis company. The entity will use the cash invested by STEM company to gain access to new markets and develop new products. Yes, we are investors. STEM company is the investor. STEM company is the investor of which company? Of this new entity. What is the name? The name is Emphasis company. Yes, and Emphasis company then he will use they will use the cash to develop new products. At 1st January X7, the carrying amount of the net asset, just leave it, contributed by three companies was 310, but the fair value of the net asset contributed The fair value of the net asset contributed was 470. That means we got the company with fair value of 470. We got the company with fair value of 470,000 times our share is 40%. Our share is 40%. So dear student, I just use these numbers in my calculation. So 470,000 multiply by 40%. 470,000 multiply by 40% is 188. 470,000 multiplied by 40% is 188. That means STEM company got the fair value share of 188. STEM company got the fair value share of 188 by just paying how much? By just paying 150. By just paying 150,000. So this is a gain of bargain purchase. This is a gain on bargain purchase, and the entries which I just made was perfect. Now I have a common sense questions for you guys, because you guys know some business as well. Why? Listen, there were three members: 40 by STEM, 40 by STEM, 40 by another guy, and 20 by another guy. Now just think, they gave us the other two owners, allowed us the other two. There are other two owners. We have 40. STEM has 40. STEM has 40. The other guys have 40 and 20. See, but the fair value of net assets contributed, total fair value of net asset contributed was 470. That means the worth of this new company made by three of us is 470,000, and 470,000 times 40% is 188. 470,000 times 40% is 188. So we as a STEM company should have contributed 188. We as a STEM company should have contributed 188,000, but the other two agreed for 150. Why the other two allowed us for 150? Why the other owners? There are other owners, 60% owners. Why did they allow us for 150? This is the question. Can you explain? Can you give answers? I'm waiting for your answers. One very good answer. Yes, excellent. One answer is very good. Maybe because the company in our, yes, the other two guys were desperately looking for a partner, they were running short of cash. One excellent argument. STEM company must have expertise. This is a technology game. Listen, this company is made for research and technology thing. So there is a possibility that we have some competitive edge. STEM company knows some big details of the market. So now we will share our expertise free of cost with them. That's why they have given us initial discount. That's why they have given us initial discount. Very good, very good contribution. Liquidation issues must be there with those two. Yes, there may be synergy gaining. Yes, very good. Or maybe because the STEM company. Yes, the expertise point, the market share point, the brand name point. Maybe STEM company is a big brand name, and if they join hands with these other guys, they will also get a boost. They will also get a boost, right? So these all things are possible. And one thing is also possible. Listen, this fair value of net asset is normally calculated through a valuation. These fair value of net assets are calculated using the valuation teams. So there is a possibility that valuation team has done some mistake. The valuation team has done some mistake. Yes, this is a possibility. Listen, this is SBR. This is not 1 plus 1 2. This is not closed question. This is open question. Maybe your comment is different from my comment. Maybe your comment is different from examiner comment. This is possible. This is totally possible. So maybe possible that valuation guy, those who valued this fair value of net asset, they have done some mistake. Yes, this is possible. And one more point. Maybe, look at me, a very technical issue. Maybe we signed the deal 2 weeks before. And within 2 weeks the fair value changed. After the announcement. The fair value of the company has been changed like this. Wait, for example, today Apple company, the trillion-dollar company, Apple company, just think, bought shares 40% shares of a company means a significant share, 40%. So when this news will come in the market, automatically that company's worth will go up. So the valuation will change. So there is a possibility that these values are calculated after 2 or 3 weeks, after some time of the signing agreement date. So these all are possibilities which you have to discuss. You have to discuss some of them. I hope you got my points. And yes, I am happy you guys wrote a lot of things. You guys contributed a lot. Good. So now this is the thing. See, first of all, according to IS 28, now that don't worry about that gain on bargain purchase. I've already explained you in detail. According to IS 28, where an investor's investment is less than the share of the fair value of the identifiable net assets acquired, this result in a gain to the investor and is referred to as gain on bargain purchase. Yes, we just paid 150,000. In return we get the net asset share, fair value of net asset share 188. So we got more share but we paid less, so it's a gain. Yes, it's a gain, common sense gain. Then IS 28 states that on the acquisition of the investment in an entity, any yes any between investment in an entity, any between the cost of acquisition and the investor shares of fair value of net any difference between the cost of acquisition and the investor shares of fair value of net identifiable asset is accounted for like goodwill in accordance with IFRS 3 business combination. I told you the same accounting, but yes, see, one more thing I have written here just to remove confusion. But goodwill is but included within carrying value of investment in associate. Remember, the treatment is same. The goodwill treatment is same, but this positive goodwill will be included. Positive or negative goodwill will be included in carrying value of investment in associate. I showed you this through entries. Thus, any excess of fair value of the identifiable net asset over the cost of the equity would be recognized. Now, come to the point. Come to this question. This question was not about positive goodwill. This question was not about positive goodwill. This question was about gain on bargain. So, thus, any excess fair value of net identifiable assets over the cost of equity investment would be recognized as a gain on bargain purchase in earnings on the investment date. Now, let's give the reason of this bargain purchase. Before recognizing a gain on bargain purchase, STEM company should reassess. We should check whether it has correctly identified all of the assets acquired and all of the liabilities assumed as part of investment. Because fair value of net assets is equal to assets less liabilities. Net assets is equal to assets less liabilities. So whether the valuation and we have accounted for everything properly or there is some mistake, please check. In order to ensure that all identifiable assets or liabilities are properly recognized, okay, then I have added one extra point. See, extra point. Why other parties agreed on this? Maybe we have some specialized knowledge or context, etc. See, I have added this point. The extra pt means point. I just discussed this point with you guys, that there is a possibility why the other parties allowed us to pay less and to get the more share, because maybe we have some knowledge related to this technology. Or see, this announcement impact, I gave you example of Apple company. There is a possibility of these things as well. Okay, and here is the double entry. Did you understand it? Did you understand it? Please tell me. All of you please comment. All of you please comment. Did you understand 80, 70% of this? Did you understand 80 or 70% of this? What would be the description? Simply you have to write gain on bargain purchase. Yes, credit to P&L means gain on bargain purchase. Simply write the word gain on bargain purchase. And in the entry, we write P&L, profit and loss means income. Okay. Now let's do a very major standard revision, and that will come in tomorrow class past paper as well. That will be coming in tomorrow's class past paper. In the latest attempt they tested this. This is basically IFRS 2 share-based payment. IFRS 2 share-based payment, but to be very honest, I will only discuss the technical issues in detail. The normal thing, we won't waste time on normal things. You know, share-based payment. There are three types of share-based payment. Number one, equity settled share-based payment. Equity settled means today I gave a target to employees that to stay with me 3 years, and after 3 years I'll give you my own shares, my own company shares, but strictly I'll give you shares, pure shares. That means this transaction will end in equity, will be settled in equity pure. So that's equity settled. What is cash settled? In cash settled share based payment, I will give target to employee that to stay with me 3 years, and after 3 years I'll give you cash equivalent to the market price, equivalent to the market price of my own 10,000 shares, my own 10,000 shares. So now this is, yes, this is also share based payment but cash settled, because in the end I'll pay cash, in the end I'll pay cash. And the third thing is options. Third thing is option. Sometimes we give option to our employee that in the end you can ask cash or you can ask shares, you can ask cash or you can ask shares. Okay, right? Now what are the some basic characteristics of equity settled? In equity settled share based payment, we promise to give shares, pure shares. In the end we'll give, we always use, in equity settled share based payment, we always, this is the basic characteristic, we always use fair value of option at the grant date. We always use fair value of option, share option at the grant date. Okay, no need to the future fair value options is, if it is given, is irrelevant, right? Then, you know, there are two types of grants. Some grants are unconditional grant. That means we say employee, take these shares and enjoy, take these shares, no need to do anything extra. So these are unconditional grants. And there are some grants which are conditional grants. Conditional grants, that means we give target to our, we add vesting conditions, we add vesting conditions with the grant. Okay, so vesting conditions are normally these three: service condition, and then performance non-market, and performance market. Service condition is like, I asked my employees to stay 3 years with me or 4 years with me. So you know, for service condition, we must check at the end of each reporting date that what are the chances of fulfillment, what are the chances of fulfillment, and we need to adjust at the end of each year end. If some employees left or some employees says yes, we will stay till end, so you need to re-estimate each and every year, and at the end of each and every year about service conditions, right? The second is performance non-market conditions. Performance non-market condition means performance target other than share price, performance target not linked to share price. Okay, like I have told my employees to increase my sales from this to this, EPS this to this, staff turnover this to this, inventory turnover this to this. Okay, so these are all performance non-market targets, performance non-market conditions. The treatment of performance non-market condition will be same as service condition. You must check at the end of each reporting date whether it will be fulfilled or not. Okay, so you have to revise your expense at the end of each reporting date. Now the last and the different one, performance market condition. Performance market condition, for example, you gave a target of share price to your employee. You gave a target of share price, you gave a target of share price to your employee. Okay, now in performance market condition, each and every probability will be taken in the fair value of option in the grant date by the statistical tools. So at the end of each year end, you don't need to see the share price, you don't need to see whether we are meeting the target or not, no need to see at each reporting date. Okay, this is how you studied. I'm just giving you few points, summary points. Now, the second thing, one more thing. In equity settled share-based payment, the entry is always debit P&L, debit expense, credit equity, debit expense, credit equity. Some students make entry P&L debit, equity credit. Some made the entry P&L debit, OCE credit. Some students make the entry P&L debit, SBPR. SBPR stands for share based payment reserve. SBPR stands for share based payment reserve. Okay, that's your wish which entry. All entries are correct. Now cash settled share based payment, in cash settled share based payment, what is the identification tool? This is the identification tool, SAR. Normally the word SAR written in the question, which means share appreciation rights. SAR written in the question, which means share appreciation right. What do you mean by share appreciation right? Listen, today I gave a target to my employee to stay 3 years with me, and at the end of 3 years I'll give you one share. I'll give you one share for $50. I'll give you one share for $50, and total 10,000 shares will be given to you. Total 10,000 shares will be given to you at the exercise price of $50, and the transaction will be settled in cash. And the transactions will be settled in cash means, let us say at the end of year 3, the stock market price of our share is $10. Sorry, the stock market price of our share is $120. 120. Our shares are trading at $120, but I promised my employees to give shares for 50. But I promised my employees to give you shares for $50, and in the market the shares are at 120. So how much benefit the employee is getting? Employee is getting $70 per share. Employee is getting $70 per share. This $70 per share will be given to employees in the form of cash. This $70 per share will be given to employee in the form of cash, okay, so this is all cash. This is share appreciation rights. Okay, now once you recognize that this is a cash settled share based payment, so now what is the difference between equity settled and cash settled? We use fair value of option at the end of each period. Now you don't need to use fair value of option at the grant date, but you have to use year end fair value, because now it's a liability. Now you have to pay the real market value. Okay, in the end, second difference, in the end we have to pay cash based on market value of shares, not shares. Okay, and the third difference is the double entry. Now the double entry will be debit P&L and credit liability. In equity settled share based payment, we don't we only give shares and the entry is P&L debit, equity credit. But in cash settle, the entry is P&L debit and liability credit. One student is asking one question: what if in the end the market price is less than exercise price? Then they won't exercise, then then nothing will be given to them, then nothing will be given to employee. Okay, then nothing will be given to employee if the market price is less than excise price. Now some technical issues. Group SBP. Group SBP. This is called group share based payment. Group share based payment. Listen. Can you see this circle? This circle is group. This circle is group. Now wait. You know what is the scope of IFRS 2? Just concentrate on the scope of IFRS 2 with me. For example, we are taking some services or we are buying any goods, and in return we are giving our shares. In return we are giving our shares to our employees, or we are buying some goods and we are paying in the form of shares, or the market price of shares in the form of cash. So these all are in the scope of IFRS 2 share based payment. These all are in the scope of IFRS 2 share based payment. Now let us say, just think, parent company acquired S company 3 years back. Parent company acquired this subsidiary company 3 years back, and now they are proper parent subsidiary relationship. They all belong to one group. They all belongs to one group. Now listen. And in the group account, you always think this circle. In the group account, you always think about this circle. Now parent company today entered in S company. Parent company management guys entered in S company, and they offered S company employees. They offered S double E means employee. They offered S company employees a deal that if you guys stay 3 years, you will get shares of P company. That P company will give shares to employees of S company. I repeat, P company acquired S company 3 years back. So now it's a proper parent subsidiary relation going on since 3 years. 3 years have been passed, right? Now today, parent company's management guys entered in S company, and they offered S company employees a deal. They said, dear employees, if you stay 3 years with this S company, we will give you our shares. We will give you this parent company's shares. Okay. Now this transaction is a pure equity settled share based payment for group accounting. This is a pure equity settled share based payment. Why? Read this line. Read this line. Read this line. Are you getting? Very simple. P company, one member of the group. P company is also one member. One member of the group issuing shares within the group. That means group employees. S company employees and P company employees. They all are group employees. They all are working for the group. If you see the group point of view, parent company employees and S company employees, they all are working for the group, and parent company is giving their own shares to group employees. So from the group point of view, we are giving our own shares. From the group point of view, we are given our own shares to our own employees for a certain target. Yes, this is pure IFRS 2. This is pure IFRS 2 will be applied in the group books. Did you understand? I'm just discussing group books right now. Yes, there is a separate topics of individual books. Just we are concentrating on group books right now. Please try to understand. In the group books, this transaction will be equity settled share based payment. This transaction will be equity settled share based payment. This transaction will be equity settled share based payment. Yes, I got your question. This is my next topic. Don't worry. Now, next issue. Next issue. this case, you know, this is the case which is written in front of you. This is F7 level, FR level case, F7 FR level case. Listen, you know, when parent company acquires as company, see, when parent company acquires as company, parent company go and does meeting with S company's controlling shareholders. I repeat, when parent company buys the running business of S company, or when parent company acquires S company, parent company first go and meet the S company's controlling shareholders. Okay, and parent company pays a price to these S company's controlling shareholders. Okay, so if parent company is paying the price to S company's controlling shareholder in the form of shares, then this is never IFRS 2. This is never IFRS 2. If parent company at the date of takeover, if parent company, open your eyes and ears, at the date of takeover, issuing its own shares to S company's controlling shareholders as a part of purchase price, as a part of consideration, then this is never recorded, then this is never treated under the scope of IFRS 2. This is pure IFRS 3 business combination. That's why, let me give you a logic. That's why when you were in F7 or FR level, your teacher taught you this case, and in FR level there was no IFRS 2. In FR level there was no IFRS 2. Yes, there was IFRS 3 in FR, because this thing belongs to IFRS 3. This thing belongs to IFRS 3. Okay, so the previous case was different. In that case, parent company was issuing shares to S company's employees just for their motivation, to motivate your employees by giving them target. So that means they were giving target to group employees. In return, the employees were giving services to group. So that was pure IFRS 2, but this is not IFRS 2, this is IFRS 3. This is IFRS 3. Just tell me, did you understand these 2 points? Don't go in any technicality. I will teach you technical issues in detail. The real technical issue is this. See, the real technical issue is this. Did you understand these two basics? Don't worry, one guy is asking question, but this will be covered in the next meeting. Don't worry, I have notes and I have all technical issues related to this topic, because this is a tough topic for everybody. And it came in one past paper as well. I think that is September December 2019. Yes, I forgot the name of that past paper. September, if that topic is replacement awards. I forgot the name of that past paper. September December 2019 past paper. It came once. And normally for students, yes, Leupold company, very good. Yes, Leupold company. So it's a challenger for students sometime. So I will discuss that thing. See, let me show you the slides. I have the slides very, see this area. See this. I've made the slides, but today, as we are short of time, so we'll discuss this issue tomorrow class in the beginning. Tomorrow in the beginning, I will discuss. Okay, so that's it for today's class. We'll share you these slides. Okay, and take care and think positive. Bye bye.